Okay, ladies and gentlemen, another wonder video. Review of some questions in Chapter 9, which is long-term debt. Read this question. Let's read it together. We recorded cash sales of $510 for the month, and we collected sales tax of 4%. And we send the sales tax liability to the state in June. So let's record the cash sales plus the sales tax. Remember now, the company is an agent of the state. We gross up the sales for the amount of the sales tax, and then we remit it to the state. So take a minute, look over the question, come up with your entry, and I'll come back. Okay, here's a continuation of this. So if we recorded sales of 510 and our sales tax is 4%, our total liability is 510 times 1.04. It's our 1.04, which is the sales tax rate of 4%. So that means our total cash collected, 530, 400. Our sales or revenue count is 510, and sales tax payable or some comparable account title is $20,400. That's it. So this is a sales tax liability. Please take notice of this because you might be seeing it again, if you know what I mean. Thank you. Next one coming up. Okay, here's our next question on unearned revenue. Unearned revenue. I want you to take a minute and read this question. Pause the recorder for a second. I'll be back in 60 seconds. Okay, so we're talking about unearned revenue. Why? Because we're selling 6-month subscriptions. So we don't earn this revenue up front. We earn it over a 6-month period. So this happened on November 1st. Okay, so we sold 106-month subscriptions plus a sales tax of 7%. So take a second and do a little calculation and find out what our gross amount of cash collected was. And then we'll figure out the entries in a second after that. So I'll be back. Okay, back to you. $96,300 is the total amount. So if we want to make this entry, we're going to debit cash, $96,300. We're going to credit sales tax liability, sales tax payable for $6,300. And we're going to credit an account called unearned revenue for the difference, because remember now, we haven't earned this revenue. So it's $90,000. Okay, so take a minute and tell me, do a little calculation, what entry are we going to make on December 15th and what entry are we going to make on December 31st to make the necessary year-end adjustment. This is the big one, the year-end, for the amount of subscription revenue earned. I'll be back to you. On December 15th, we're going to remit the amount of taxes to the state. So we're going to simply make an entry called sales tax payable. We're going to debit that, reverse that out, $6,300, and credit cash, $6,300. And we're going to, in effect, liquidate that liability for sales tax. Take a minute now and look at the necessary year-end adjustment. We sold it on November, and on December 31st we had 2 months. So 2 months out of November, December, January, February, March, actually April here. So 1/3 of the revenue was earned. I'll be back to you in 60 seconds. We'll do the entry for the year-end accrual. Okay, so we're making our December 31st year-end. And my assumption, by the way, in this question is that subscriptions started flowing on November 1. So we got November, December, January, February, March, April. So in December we had 1/3 of $90,000. So we're going to debit unearned revenue for $30,000. We're going to credit revenue for $30,000. And of course this entry is necessary because we sold 6-month subscriptions. My assumption is they began November 1. So 2 months have gone by, November and December. So we're going to reverse out 1/3 of this $90,000 or $30,000. We're going to reverse out the unearned revenue for that 1/3 portion, and we're going to pick up the revenue, earned revenue or sales, whatever our category, whatever our account title is, for that remaining third. And that's it. That's all there is to that particular type of question. We have unearned revenue as a liability, and we have sales tax. Okay, hold on, and we'll go to the next one in a minute here. Okay, ladies and gents, this next question is on a warranty payable. So we're going to break this down a little bit. Remember that warranty expense, in order to properly match all expenses with revenues, we should record the warranty expense along with the sale. So take a minute and read this question, and I'll be back to you in a second. Okay, so this question basically says we have a estimated warranty payable balance. This is the liability account on December 31st, 2015 of $6,000. And our experience is 4.5% of sales turn into warranty claims. So we made sales in 2018 of $306 and paid $11,000 to satisfy the warranty claims. So the requirements are: record the sales, warranty expense, and cash payments made to satisfy warranty claims during 2018. Okay, so take a minute, get out your paper and pencil, your calculator and whatever, and let's figure out what our entry should be, and I'll be back to you. Pause the recorder and I'll come back in a minute. Okay, back to you. So here's, we did some calculations here. First thing is the warranty expense is, or the warranty liability and warranty expense, $13,770. Okay, that's warranty expense. So that is going to fit into this entry just very nicely. So we're going to record our sales of $306. So debit cash or accounts receivable $306. Debit warranty expense, which is the matching of warranty expense with the appropriate revenue at 4.5% is our rate. Credit revenue or sales $306, which is the amount of the sales, and credit accrued warranties payable or warranties payable, whatever account title is given to you, $13,770. That records the sale. We're going to, for our purposes, ignore the cost of goods sold. And then we're going to go to the second part of this, part B. We're going to record the warranty claims. We paid $11,000 to satisfy the warranty claims. So our entry is going to be a debit to warranty payable and a credit to cash for $11,000. Cash or inventory or accounts payable, whatever the appropriate title is here. Inventory would be a better one here for $11,000. And that means that at the end of this period, our estimated warranty payable account, here's our beginning balance of $6,000, our accrual for warranty claims for the year, and our payment. So this will give us a revised, this looks like 19,770 minus 11, so it looks like 8,770 will be our balance, our new balance in the estimated warranty payable account. Okay, that's it for that question. Okay, here's a quick hitter on amortization schedule. This is a type of question that you run into when you're talking about mortgages here. Okay, so in this case we borrow $210. Our mortgage rate is 6%. Our payments, our fixed payments are $10,175 semi-annually. And I'm just going to do the first line of this calculation. I want you to take out your calculator and calculate if it's a half year. A 6% yearly rate is 3% for a half year. So we're going to take, first calculation here is 3% of 210. Looks like 630. Okay, 6,300. So that's going to be our interest portion, 6,300. Whoops, 6,300. So take a minute, pause the recorder, and tell me what the principal portion ought to be. I'm going to squeeze out the principal portion by subtracting the 6,300 interest from my fixed payment. Here's my fixed payment here. So I'm going to squeeze out the principal amount and then give me a revised loan balance. And I'll be back to you in a minute and a half there. Run that number, please. Okay, so you've done your calculation. Hopefully we agree on the numbers here. Interest is 6,300, which is 3% of the outstanding balance. Okay, each payment period. The outstanding balance for the first calculation is 210. So 6,300. I subtract that. 10,175 minus 63 equals 3,875. And so 210 minus 3,875 gives me 206,125, and then the process just repeats beyond there. So this is a quick hitter on how to do an amortization schedule and run that number. Okay, take a minute and look at this question. We are focusing on a long-term debt. It's a 5% long-term note payable. And we borrow the money on July 1. We have to pay it off in 3 equal yearly installments plus interest each July 1 for the next 3 years. So take a minute, read through that, and come back and we'll do some number crunching here. Okay, so this situation clarifies itself here a little bit more. So we have our total amount borrowed, $1,050,000, 5%, 3 equal yearly installments each July 1 for the next 3 years. So this all happened in July of 2018. So by year end 2018, we had, by December 31st, we had 6 months interest due, and we had one of the 3 installments would be considered a current liability. Okay, so take 1 second and come back and work out what that would look like, and we'll compare notes in a minute. Okay, so here we go here. We have $1,050,000 divided by 3 gives us $350,000 a year for the yearly installments. So as of December 31st, 2018,